Hello, it's Big Chads, and this is the Trading Encyclopedia Daily Education series on my YouTube, Chads Trading. You can find me on Twitter at Big Chads and Bitcoin Live, where I am a founding analyst. For today's lesson, we're going to talk about a concept called asymmetry in a trading setup. What does it mean? Well, of course, you can pause and read this on your own time, but I have a little selection to show you from my second book, Trading Wisdom. It's just from lesson 46 about stop losses. And it basically talks about a rule in classical charting where you want to have at least 3 times the potential profit to your stop loss. So a 3-to-1 profit to stop loss ratio. Here's an image potentially as well. You have the current price, your stop loss is lower. Here it's only 2-to-1, right? $10 gain, $5 loss, 2-to-1. But the idea is that you have limited downside with greater potential on the upside. 3-to-1, 4-to-1, maybe even better. So let's look at a couple different examples. So first of all, the best way to get this type of situation is wait for a price interaction with a key level. If you have the price consolidating in a well-defined range, taking a trade in the middle of the channel one way or another is hard to manage your risk. But taking a short at the top of the range, taking a long at the bottom of the range, either of these are asymmetric because you have, for the short, limited downside for being wrong, for the long, limited downside for being wrong. If you're taking a long here and you're wrong, you have a close by stop loss, but you have potential to continue much higher. This is likely much more than a 3-to-1 or even 4-to-1 ratio. So you want to have price interaction with the key level number 1 to begin with. Take, for example, this pattern on Ethereum. We have what is a right angle descending broadening wedge, and the measured move from it, depending on whether you're using logarithmic or linear, 6,500 or 10K. So the idea, say the more conservative target of 6,500 from around $4,200. Your stop loss for taking a long on this high time frame range break would be, $3,800, $3,700, somewhere nearby. Maybe this peak, you say, as long as it holds above that peak, you're managing your risk. You have limited downside and very strong potential to the upside. Here is another example on INJ. INJ had a nice topping pattern. The price broke down, and you had a series of tests, underside tests. Taking this setup, you have asymmetric risk to reward. If you're wrong, you're only wrong for a little while because it would recapture these lows. But if you're right, you have all this potential for trade. All this potential for profit. Same thing here on the retest. If you're wrong, you're only wrong for a little bit. But if you're right, you can do really well. So the idea with asymmetry in a trading setup is making sure that whatever your stop loss is, it's at least 3-to-1, if not more. And to gain this, you want to start out and make sure that you have price interaction with the key level you're entering as close as possible to that key level. This is asymmetry in a trading setup, and this is the Trading Encyclopedia Daily Education series on my YouTube, Chads Trading. Find me on Twitter at Big Chads and Bitcoin Live, where I'm a founding analyst. Thank you, folks. I will talk to you soon. Big Chads out.